Hi guys, it's Patrick, Ben, and James here. Our topic is interpretation of accounts, particularly investment ratios.
There are hundreds of ratios that accountants could use within business. However, Dyson focused on 15 as the most popular and beneficial, grouping these into four categories: liquidity, profitability, efficiency, and investment.
Whilst we focus on investment ratios, it is important to acknowledge that there are other options to interpret business accounts with, although Dyson suggests only using a limited number of ratios to minimise the amount of calculations required.
Ratio analysis is only relevant when comparing the data with TIE, which is trend, industry, and expectation. This gives an indication of the company's performance as it can be benchmarked against previous results or its competitors.
Investment ratios. These set of ratios can be differentiated to liquidity, profitability, and efficiency as they are primarily of interest to investors, rather than the shareholders, managers, and creditors. According to Dyson, there are four basic ratios within investment: dividend yield, dividend cover, earnings per share, and the price to earnings ratio.
So, Paddy, what does dividends mean then?
Well, James, according to Investopedia, dividends is a distribution of a portion of a company's earnings decided by the board of directors to a class of its shareholders. Dividends can be issued as cash payments, shares of stock, or other property.
So is that where the phrase divvied out has come from then?
Yeah, it's basically sharing out a total.
So, firstly, dividends yield. It is calculated by dividing dividend per share by market price per share times by 100. It measures the rate of return for an investor by comparing the cost of their shares with the dividend receivable.
For example, Manchester United has an annual dividend of 36 cents, with the current market rate of approximately $14.68. Therefore, you do 36 cents divided by $14.68 times by 100, which equals 2.45%. This means that Manchester United's dividend is 2.45 of the market rate.
Now, moving on to dividend cover. The basic understanding of this ratio is that it allows an organisation to indicate their ability to pay off future dividends, which is why many companies like to use it, as it allows them to plan ahead and assess how prudent they must be in regards to their future investments and expenditure throughout the year. They must then take into account throughout each accounting period that if the future dividends increases beyond the current earnings per share, they must then drop their dividends per share for that period until they can improve their earnings.
In regards to our JD Sports example, this is not the case, as their current earnings per share is valued way above the average dividend per share, meaning they are operating at a stable and successful level.
If you own a share in a company, it means that you own a portion of that business and therefore have to share the profits with the other shareholders. Earnings per share, or EPS, calculates how much an investor's return is per share, and the formula is net profit minus preference shares divided by the number of ordinary shares.
Although, it is important to remember that this ratio doesn't provide any insights to the quality of a company's earnings.
For example, the Nasdaq states Nike EPS of 1.23 for the fiscal year of 2017, whereas Under Armour is 0.21. However, both companies may generate their earnings using different amounts of capital, so EPS doesn't reflect the efficiency of either business.
If an investor wants to calculate whether a share is over or underpriced, they can use the price to earnings ratio. This simple calculation is market price per share divided by the previous ratio, earnings per share. According to Collins and Taylard, this ratio shows investors what the market anticipates the growth of a company to be.
So, Ben, does that mean the higher the number, the more growth is expected for the company?
Exactly, Paddy. For example, according to Nasdaq on the 3rd of January 2017, Adidas's PE ratio was 28.94, whereas Puma's was 55.04. These figures show that the market expects Puma to have higher levels of growth in the future compared to Adidas.
When interpreting accounts, organisations must be aware that there are some limitations to this procedure, which, as mentioned in our report, can result in incorrect perceptions of the business's performance. Many suggest that many of these limitations are centered around the data used being insufficient to drive a detailed and advanced conclusion. This can be due to the date of which they are recorded or an internal manipulation for a member of staff within the organisation in order to give a false interpretation of the business to investors and clients.
Alongside this point, it must also be acknowledged that investors must value their common sense over a company's word or opinion, as after all, they are the ones parting with considerable amounts of money, and so they should make their own judgment on the investment as opposed to simply interpreting accounts.
On the flip side, there are positives for account interpretation and using investment ratios. They do give potential investors a valid understanding of a company's performance, giving them the information to make decisions which can be justified. Ratios also enable management as well as investors to compare performance with previous data to identify trends, and also against their competitors within the industry. Plus, it's a simple way of seeing if a company has met its targets and allows management to determine the financial stability of their business.
To conclude, if any of our sport organisation examples were aiming to increase their share price legitimately and not by manipulating the published data, they would need to ensure that the company is operating with high levels of efficiency, continuing to be sustainable, as well as showing consistent growth to the market.
A simple review of the profit and loss account, balance sheet, and how the capital is being utilised will highlight certain areas which can be improved, such as increasing the price of products, the quantity sold, reducing costs, reviewing trade debtors, and reducing current liabilities. This review will increase the efficiency and net profits of the company, which in turn will increase demand and the price of shares.
From the perspective of a potential investor, it would be prudent to use a range of ratios to fully analyse a company's performance to gain an insight into current operations when compared against trend and industry to construct expectations of the future.
And thanks for listening.